Good afternoon, everyone. We'll continue our discussion. Yesterday, we started this external sector and we discussed the different components of the balance of payment and current account and capital account. Under that current account, we have also seen the other components as well. Under the capital account as well, we also discussed different components. So we just started this foreign exchange market and we introduced different players who are there in the foreign exchange market, and today we'll continue our discussion. Before we start, if of any doubt with respect to yesterday's class, please let me know. If any doubt, any query, Eddie has posted one post, the screenshot of something. If of any doubt, please tell me. First we'll discuss that and then we'll move to the next topic. So we were about to discuss flexible exchange rate. Flexible exchange rate, which is also known as market determined exchange rate. Flexible exchange rate, which is also known as market determined exchange rate. It has the term foreign goods is used for the domestic goods only. It's saying for a other country, with respect to other countries, if you export your goods, that is the foreign goods for the recipient country. That's why this word or terminology has been used. Okay, we'll come to that later. Let's focus on this. We'll discuss those components here as well in today's discussion. Okay. So I told you flexible exchange rate, which is also known as market determined exchange rate. So market has two components. One is your demand and supply, and market determined exchange rate, when we say, that means again it has demand for foreign exchange and supply of foreign exchange. When we say exchange rate, what is the meaning of it? I am not audible to you. I think it's fine, it's working well. Please check from your side. Market determined exchange rate, so it has again two components. One is demand for foreign exchange, another one is supply of foreign exchange. So let's take the first component, demand for foreign exchange. Demand for foreign exchange, or simply you can say demand for foreign currency. Demand for foreign currency. So when a country demands for foreign currency, if anyone can answer it, when or what is that situation when a country demands for foreign currency? Let's say dollar. When a country imports goods and services from other country, then a country demands this foreign currency. So simply you can write imports of goods and services. Simply you can say imports of goods and services, or when a country wants to purchase the goods and services of other countries. This is number one. Number two, when the demand for foreign currency will increase. Suppose a number of investors from your country, they want to invest in US, let's say. So the demand for foreign currency will increase. So simply you can say capital outflow. Capital outflow is one such situation. That means capital is going from your country to another country. So demand for foreign currency or demand for dollar here in our example will increase. Now the other aspect is supply of foreign currency. When the supply of foreign currency will increase, or you can say supply of foreign currency in your country will increase, the situation or the scenario is export of goods and services of a country will increase, then the foreign currency will come to your economy, or dollar will come to your economy. So when you increase the export, then the dollar will come back to your economy. That means supply of foreign currency will increase in your economy. Similarly, capital inflow in terms of what? In terms of investment. Suppose your economy is doing well, most of the investors, they want to invest in your economy, then capital inflow will be the case, investment will come to your economy, leads to supply of dollar will increase in the economy. Clear? Now let's determine the exchange rate. Simply the determination of exchange rate, as I have already told you, demand for dollar, here again supply of dollar. I am assuming that you have understood why the demand curve is downward sloping and why this supply curve is upward sloping. I assumed that you have understood the mechanism of demand and supply curve. So now let's determine the exchange rate. So the point at which demand intersects the supply, that is known as equilibrium point. So here again, both this demand for dollar or foreign currency, it is intersecting the supply of foreign currency, and finally we are getting the equilibrium exchange rate, or the rate at which one currency is exchanged against another, or simply you can say $1 equals to the amount of Indian rupee, that is known as your exchange rate, as we have already discussed yesterday. Now so here we are discussing the flexible exchange rate system. As I have already told you that flexible exchange rate system means the market determined. Now just try to understand here, in our simple demand and supply mechanism, what happens? Simply, this is the equilibrium point, the demand of a product and supply, demand for a product and supply of a product, and the point is equilibrium point, and this price is your equilibrium price and this is your equilibrium quantity. Let's assume that supply remaining constant, simply increase the demand. Again, I am assuming that you have understood this, why this rightward shift of the demand curve. Let me tell you that when demand increases, demand curve shifts to the right. When demand increases, demand curve shifts to the right. Then the new equilibrium point is this. The new equilibrium point is this. If you draw this to the vertical line, this is, let's say, P1 is the new price. That means price has gone up. So supply remaining constant, if demand increases, then price also increases. Now this new price is P1, so price has gone up. Clear? Now let's apply this formula here as well. This is the old exchange rate, let's say E1. This is the old exchange rate, that means existing exchange rate or equilibrium exchange rate is E1. If I increase the demand for dollar or demand for foreign currency, then the new equilibrium point is this. Now exchange rate is E2, which is the new one. That means exchange rate increased by increasing the demand for dollar. So can you please tell me what this condition or what this situation is called, or what is the name of this situation? Anyone? This increase in exchange rate due to increase in the demand for foreign currency or dollar. Then what would be the result? That means price of foreign currency or dollar has increased or gone up. That means dollar is appreciated and rupee is depreciated. Dollar has been appreciated and rupee has been depreciated. So if any increase in demand for foreign currency or dollar, increase in exchange rate, so price of dollar has increased, that means the price of dollar has become dearer, but against that the price of rupee has been cheaper. So rupee has been depreciated and the dollar or the foreign currency has been appreciated. Any doubt on this? Let me draw you the other one as well. Suppose this is the demand curve, demand for dollar, and this is supply of dollar. Again, this is the equilibrium point or exchange rate. Suppose due to any reason the supply of dollar has increased, then rightward shift of the supply curve. This rightward shifting of the supply curve means the new equilibrium point is this, let's say E1. Earlier it was E, now it is E1, and this price is the new price. That means price of dollar has decreased. Price of dollar has decreased. What does it mean? It means price of dollar has been cheaper. That means dollar has been depreciated. Dollar has been depreciated and the value of rupee has been appreciated. This is two cases we have already discussed. In this case, due to increase in demand, price of foreign currency or dollar has been appreciated, rupee has been depreciated. Here is the reverse. The value of dollar has been depreciated and rupee value has been appreciated. Simply you have to remember, if demand increases of a commodity or of a product with respect to its supply, then price increases. If supply of a product or a commodity or an article increases with respect to its demand, then price goes down. So please tell me if you have any doubt till now, then please let me know, otherwise we will move forward. अभी तक कोई डाउट है? Any doubt till now? समझ में आया नहीं आया, क्या प्रॉब्लम आ रही है, प्लीज लेट मी नो. Impact will come to later, just wait. We'll discuss what is the impact of depreciation and appreciation, what happens, we'll discuss that, okay. So let's come to, when I said this market determined exchange rate, that means it's simply determined by only these two market forces. There is no interference of government. Neither government nor any authority interferes in this market determined exchange rate, purely based on market. So in this regime, one such aspect which also affects exchange rate, that is interest rate. Here interest rate is not the interest rate which is charged by different banks against any consumer loan. Here interest rate means simply the rate of return. Here interest rate means the rate of return, that means rate of return out from the investment that has been made in the economy, out of the investment that has been made in the economy. So that is known as your interest rate or rate of return. Let's discuss how this rate of return or this interest rate affects the exchange rate. Yesterday I have I gave you that example. Suppose two countries, let's say India and US. let's say in US the rate of interest is 10% and in India the rate of interest is 8%. That means if you have invested 100 rupees, you are getting 10 rupees return out of that 100 rupees, and here you are getting 8 rupees out of that 100 rupees. So all the investors across the countries, multinational companies, those wealthy individuals, what they generally do, they invest in US. That means capital will move from India to US. In fact, the investors of India also will start investing in US. Then what would be the implication? The demand for a dollar will increase because more investment will be there in US or US currency. So demand for dollar will increase. Let's apply this in this diagram. Supply and demand. So when, and this is supply and demand of what? Dollar. So demand for dollar has increased. So this is the new equilibrium point. That means exchange rate has been increased. Simply you can say that the value of dollar will appreciate and the value of Indian rupee will depreciate. So this is the case when a country provides a higher rate of return. So all the capital, all the investor will go to that country, and there if rate of interest is higher or return is higher, then the demand for that currency will increase. Reverse will be the case if in India the rate of interest is 10% and US is 8%, then this would be the reverse. Indian rupee will appreciate and this dollar will depreciate. Clear how this interest rate or rate of return affects the exchange rate? Yesterday, I think someone had asked this question, why ruble is depreciating? That means depreciating means weaker. What does it mean? Now due to international sanctions on the Russia, no one is interested to trade with this Russia. So the Russian currency, no one is demanding in the market. That means supply of ruble has increased in the international market. That's why the currency has become weaker against all other foreign currencies. So ruble has now become weaker due to increase in the supply in the international market, because no one is demanding ruble to invest in Russia, or no one is purchasing this oil and gas from Russia. That's why the ruble currency of Russia has been weakened. Any doubt on this? So simply this rate of return, that example I have given you, simply you can see that those bonds issued by different governments, and if rate of return on the bonds issued by US is 10% and India government's bond, the rate of return is 8%, then rest is the story that I have already discussed with you. Any doubt till now? Have you got the answer? I think I don't know the name who had asked this question about ruble and all. So if you have understood it, then it's fine. Okay. Yesterday also I have already discussed with you the speculation, how speculation also affects exchange rate. This is again comes under this market determined exchange rate or flexible exchange rate. Speculation, I have already told you that something like prediction, you are not sure about that particular event, and speculation always leads to risk, because you never know whether that will exactly happen in the future or not. In the share market, stock market, what happens due to the speculation? So if your speculation works well, then you gain from the capital market or the share market. But if your prediction or your speculation fails, then you will be in loss. So that risk has been attached with the speculation. But how this speculation affects the exchange rate, that is our point of discussion. Okay. Now let's see how. Yesterday I have given this example. Suppose some investors in our country, they speculate that $1, the present value of $1 is, let's say, 50 rupees. In future, in the next 15 days, it is going to be, let's say, 70 rupees. That means higher than the 50 rupees, or the value of Indian rupee is going to depreciate in the future. Now what will happen? So what will they do? They will keep those dollars with them. They will not exchange it with different commercial banks and other brokers. They will keep those dollars with them, so that after 15 days when they will exchange it, they will get a higher price or higher Indian rupee. So if that speculation is started in the economy, then all the investors will hold dollar. जिसके पास डॉलर नहीं भी थे, they will also start exchanging rupee to get the dollar to make profit in the future. जिसके वजह से क्या होगा? The demand for dollar will increase in the market. The demand for dollar will increase in the market. So when demand for dollar will increase in the market, then the price will increase in the market. That means the value of the dollar will appreciate and the value of Indian rupee will depreciate. Simply you can put it in this, again that particular diagram. This is the case. Clear? So speculation also affects the exchange rate. So here an increase in exchange rate means the dollar value is appreciating, Indian rupee is depreciating. Till now, any doubt you have? These are small concepts, so they can simply ask you in the prelims. They can put this statement like this: speculation can affect the exchange rate or not, or something, the mechanism they can simply ask. So this is one such speculation which affects the exchange rate. Reverse may be the case. Simply they will speculate that rupee is going to be stronger against the dollar, or suppose initial or the existing value is $1 equal to 50 rupees, and they are speculating in near future $1 equals to 45 rupees. So they will be in loss. So those existing bond or those existing dollar, they will simply exchange in the market and will get the rupee. So supply of dollar will increase in the market. So when this supply of dollar will increase in the market, then dollar will be weaker, or the value of dollar will depreciate, Indian rupee will appreciate. So it purely depends on this market forces and on this speculation. Clear? Any doubt? Any doubt you have, please tell me. समझ में आ रहा है, नहीं आ रहा है, डिफिकल्ट लग रहा है, एनी कंफ्यूजन? विल कम टू दैट ज्योति, डोंट वरी. अभी तक समझ में आ रहा है जो हमने अभी तक डिस्कस किया. ट्रिपल पी वी हैव नॉट डिस्कस्ड येट, जस्ट वेट. अभी तक जो डिस्कस किया है वो समझ में आ रही है, नहीं आ रही है, दैट इज द पॉइंट. The next is income and exchange rate. How income is related to, or how income is impacting the exchange rate. Simply you can say, suppose income of a country increases. When income of a country increases, simply the taste and preferences or the consumerism will increase of that country. When this consumerism will increase, that means the demand for foreign goods will also increase. When the demand for foreign goods will increase, simply it means import will increase. When import will increase, then definitely the demand for foreign currency will increase. When demand for foreign currency will increase, then it leads to price of dollar will increase. So what is the meaning of it? That means dollar is appreciating and Indian rupee is depreciating. Clear? So let me repeat this, how income affects the exchange rate. Suppose income of a country increases, let's say India. Due to increase in income, taste and preference or consumerism or taste and preference of the consumer will increase. So, or you can simply say the change in taste and preference, due to that the consumption of foreign good will increase, due to that import will increase, due to that demand for dollar will increase, due to that price of dollar will increase, due to that dollar value will appreciate and rupee value will depreciate. Clear? Now, this is simple logic, but a twist is here. A domestic currency may or may not depreciate, or the rupee value may or may not depreciate. Then when it will depreciate? It will depreciate when import is greater than the export. When import is greater than the export, it will appreciate or it will not depreciate, you can say, if export is greater than the import. Till the time your export is greater than the import, that means you are earning more foreign exchange. So the value of Indian rupee will not depreciate due to this. But at the time when you are importing more than you are exporting, or you are earning less of foreign currency than you are paying to other countries, then only the Indian rupee will depreciate. Clear? So this is the point. So due to this or increase in income, rupee may or may not depreciate. May depreciate if import greater than export. But if export greater than import, then it will not depreciate. Clear? Now we are coming to this purchasing power theory, you can say, or purchasing power parity theory. What this theory is all about? Jyoti, can you please answer what this triple P is all about? Because you have mentioned the name of this topic. What this theory is all about, purchasing power parity theory? Simply you can say it's a part of this flexible exchange rate system, and it helps in predicting the exchange rate. It helps in predicting exchange rate in long run. It helps in predicting exchange rate in long run. Then what exactly this theory is all about? Yes, that's true. Simply, this theory aims to or speaks about the comparison between two currencies purchasing power, or simply you can say it's a kind of comparison between two currencies in terms of purchasing power. Let me explain this with the help of an example. Suppose a burger with the same taste, same size, same thickness, everything is same, but the price of the burger in India is, let's say, 50 rupees. And the same burger, the price in US is $1. Let me repeat, the quality, the taste, everything is same in this as far as burger is concerned. So the price of this burger in India is 50 rupees, in US it is $1. So then what would be the exchange rate? Exchange rate would be $1 equals to 50 rupees. $1 equals to 50 rupees. Clear? So through this you can also determine the exchange rate, or you can simply predict the exchange rate between two countries in terms of this. But you have to ensure you are comparing with a same product. Same means everything will be the same. Clear? If you change the taste, the quality, then price may vary. Clear? So this is your purchasing power parity. I think you must have heard in terms of this purchasing power parity, India's size of GDP was in number 3. India was at third number in terms of size of GDP with respect to this triple P. So this was a question in 2019 or 20, I guess. Okay. So whenever such kind of news you find in the newspaper, just try to or pay some attention that what exactly the size of Indian GDP in terms of this triple P. Okay. Now we are moving to the next exchange rate regime, that is fixed exchange rate. What happens in the fixed exchange rate? Anyone can answer? What happens? Why it is known as fixed exchange rate? In case of flexible, we have seen it is market determined. In case of fixed exchange rate, what happens? In case of fixed exchange rate, simply you can say government decides or fixes the exchange rate. Government decides or fixes the exchange rate. Then let's say, or let's discuss how. This is demand curve and this is the supply curve. Okay. This is the demand curve and supply curve, and we have seen that in the market regime, market decides, okay, but in the fixed exchange rate, simply this exchange rate has been determined by what? The government. So let me explain this through this diagram. So this is the present exchange rate system, like E is the present exchange rate through this demand and supply, but this exchange rate has been fixed by the, let's say, government. $1 equals to 50 rupees. This has been decided by the government. Clear? Now, government, what government does? Government fixed this exchange rate as E1. Government fixed this exchange rate as E1, which is higher than the E. Now, if I draw this line, let's say in demand curve, this exchange rate is intersecting at A and this is B. Clear? So E is the existing or old exchange rate. Now government fixed the exchange rate at E1, but government saw that at this E1 exchange rate, the demand is this E1A. Again, at this E1 exchange rate, the supply is E1B. Clear? Demand is E1A, supply is E1B. Now, demand and supply of what? Dollar only. Now, that means supply of dollar is greater than the demand for dollar. Then what will happen? When supply of a commodity increases or greater than the demand, what is the price of that commodity? The price will come down. Yes, the value of the dollar will come down, or simply you can say the dollar will depreciate and the Indian rupee will appreciate. So after effects of this particular determination of exchange rate will be like this: supply of dollar greater than the demand for dollar. So what will happen? The dollar will depreciate, Indian rupee will appreciate. But government wants to maintain that E1 exchange rate. I repeat, government wants to maintain that E1 exchange rate. Government does not want to change this E1 exchange rate. But after determining that this would be your impact, then what will government do? That would be our next question. The next step would be government will ask RBI or Reserve Bank of India to observe this extra supply of dollar, or RBI will observe this extra supply of dollar. When RBI will observe, that means those extra supply of dollar will be taken away by the RBI from the market. Then the effect due to increase in supply of dollar would not be there when RBI observes this extra supply. Then the exchange rate would be maintained at this point E1, or the depreciation of dollar will not be there, so the government's interest can be fulfilled. Clear? Clear till now? Any doubt? Please let me know. So the extra supply will be observed by RBI to sustain that exchange rate at E1 point. This is the interference of the government. Here government fixed this E1, again government is interfering to sustain that E1 rate of exchange rate, so that when government increased the exchange rate from E to E1, why government increased the exchange rate? Because government deliberately wanted to devalue the exchange rate, because the term depreciation which we use in case of fixed regime or deliberately done by the government, that is known as your devalue or devaluation, or appreciation which is deliberately done by the government under this fixed exchange rate regime, known as revaluation. So mechanism are same for depreciation, devaluation, appreciation and revaluation, but the only difference is these two are market determined and these two are government determined, or the fixed exchange rate regime or fixed exchange rate system. Any doubt till now? ये mechanism समझ में आया नहीं आया? Please let me know. या दोबारा बताओ इसको? Whatever you feel, please let me know. If I've understood it, then I am explaining the other way also, or the reverse will be the case. Suppose government decides exchange rate at E2, let's say. At E2, if I write C here and D here, then at exchange rate E2, demand for dollar is greater than the supply of dollar. RBI simply, how RBI absorbs that extra dollar from the market against, see, RBI is the authority who maintains or keep this foreign exchange reserves of India. So when the supply of dollar is higher in the market, then government will ask RBI to absorb this extra amount of dollar from the market against Indian rupee. So dollar ले जाता है and against that dollar RBI gives Indian rupee or to the market or to the system or to the economy. ठीक है? This is one. Second is, suppose government deliberately wanted to reduce the exchange rate. Reduce the exchange rate means, that means government wanted to appreciate the Indian rupee and depreciate the value of dollar. So government fixed this at point E2, but at this E2 the demand for dollar is greater than the supply of dollar. This is I have already written. So when this demand for dollar is greater than the supply of dollar, then government will ask RBI again to inject the extra dollar to the market against Indian rupee. Are you getting my point? Here RBI will inject dollar or the extra demand for dollar into the economy against Indian rupee. Then question is, why government will ask RBI to inject extra dollar? Because at this exchange rate, since demand for dollar greater than the supply of dollar, then price of dollar will increase. That means exchange rate will increase towards E. But government wants to maintain exchange rate at E2. That's why government asked RBI to execute, to inject dollar into the economy against Indian rupee, to maintain that exchange rate at E2. This is the story of fixed exchange rate regime, where government interferes at the level of fixing the exchange rate and maintaining that exchange rate. Clear? That means what will happen if dollar demand for dollar will increase, price of dollar will increase. That means dollar will appreciate and Indian rupee will depreciate. ठीक है? So, but government wants to sustain this E2 at this. So simply you would be asked, let's say in a fixed exchange rate regime, if or simply you can say, they can put the statement how RBI interferes or the government interferes in the fixing of exchange rate system. Simply they can ask you a question in the statement format. Yes, dollar and rupee are exchanged against each other in terms of this interfering of government into the exchange rate market. Clear? So devaluation, revaluation I have already explained to you. Now please tell me if I've understood it. Just tell me what are the merits of flexible exchange rate system. Merits of flexible exchange rate system. Merits of flexible exchange rate system mean, the first point would be that government does not have to maintain a large reserve of foreign exchange. Government does not have to maintain a large reserve of foreign exchange like fixed exchange rate system. When RBI interferes here, that means RBI must have a foreign exchange reserve so that RBI can interfere in this market. So in case of flexible exchange rate regime, government does not have to maintain a large foreign exchange reserve. This is the first one. Second merit, और क्या हो सकता है? Government has an independent monetary policy. Independent monetary policy. That means when RBI decides monetary policy of a country, then RBI does not need to take care of this foreign exchange reserves or inflow and outflow of the capital. I repeat, when RBI decides the foreign policy, then it no need to take care of these inflow and outflow of capital. How that happens we'll discuss after a bit under the concept of sterilization. We'll discuss that, how RBI faces you can say the dilemma kind of situation to handle monetary policy as well as this exchange rate regime. We'll discuss that. So in case of flexible exchange rate system, RBI has an independent monetary policy. Clear? Then please tell me the demerits. Demerits of this flexible exchange rate system. What are the demerits? More prone to volatility. You have no control on the exchange rate, so this capital flight inflow and outflow will become easier. So your economy will be more volatile or more prone to this volatility. Suppose there is a problem or there is a you can say a crisis like condition in India, then most of the investor, they will simply flight back to the country where they are getting a higher rate of return. They will not bother about whether your economy is in a good shape or bad. Whenever they smell the problem or whenever they smell the crisis like condition is there in India, they will simply withdraw their investment. So such kind of problem will be there in case of if you have a flexible exchange rate regime. Okay. So next is, just tell me what are the merits and demerits of fixed exchange rate. Merit and demerit. In case of merit, you have a control over your exchange rate market. The volatility can be minimized if you have a control on your exchange rate market. Number one. In case of demerit, you have to maintain a large exchange reserve. You have to maintain a large exchange rate or large exchange foreign exchange reserve to maintain a kind of or to sustain that exchange rate what government wants to keep in the market. So you need a foreign exchange reserve. ठीक है? Rise of speculation is something which is related to the market determined exchange rate. Clear? So the volatility is attached with the speculation only. If let us say before this Ukraine-Russia war, if someone could speculate that India, there is a chance India will involve in the war or the market will go down, then definitely those investors will withdraw money from India and they will invest in other countries. So, this flexible exchange rate is or you can say the speculation is attached with this flexible exchange rate. Okay. Now, we are moving to the third category, managed floating exchange rate regime. Managed floating exchange rate regime. What is this managed floating exchange rate regime? Anyone? Managed floating exchange rate regime. This flexible exchange rate, you can give example of US. Fixed exchange rate, you can give example of China and Russia. But where India fits, any example of this managed floating exchange rate? Anyone? Any example of this managed floating exchange rate? Where India fits into this system? Any example, Rijul? Yes, it is mix of flexible and fixed. It is an example of mix of flexible and fixed, or simply you can say floating and fixed. Floating is same as flexible. You can use these two words alternatively, flexible and floating. Okay. Yes, India is one such example under this managed floating rate exchange rate. Now, let me explain how a country interferes in this exchange market under this regime of managed floating exchange rate. I am coming back to my this diagram, how India, or simply you can say the managed floating exchange rate is executed. Okay. Now, just see here. In this diagram or in this graph, original exchange rate is E. E is the original exchange rate. Now, due to any reason, any situation, any circumstances, let's assume that exchange rate increased to E1, or simply or technically you can say due to market forces, E1 become the new exchange rate. That means exchange rate increased, dollar value appreciated, Indian rupee depreciated. Simple. So, till E1 we have market exchange rate. Let's assume that this is good for the Indian economy, or this exchange rate E1 is good for the Indian economy, and government wants to maintain the exchange rate at E1. I repeat, government saw that it is good for the Indian economy and let's maintain this exchange rate at E1. So what government will do? Government will ask RBI to interfere in the market so that to absorb extra supply of dollar from the market against the Indian rupee, so that this exchange rate can be maintained for a particular period of time. ठीक है? This is how RBI or the government interferes in the managed floating exchange rate. Similarly, suppose due to the market forces, new exchange rate is E2 and government thought let's maintain this exchange rate because this is beneficial for the what? Economy. So government will ask RBI to supply extra demand for dollar into the economy. Clear? Now, suppose, just assume due to the market forces, E1 is the new exchange rate, but due to government thought this E1 exchange rate is not good for the economy, then what government will ask to RBI then? Government will not ask to RBI anything to interfere into the market, because automatically it will come down, because the supply of dollar is higher than the demand for the dollar. Clear? So if there is any requirement, then only RBI interferes in the market. Otherwise, till the time government thinks it is okay or it is good for the economy, government leaves this mechanism to the market forces only. But whenever government wants to interfere, then it interferes in the exchange market through RBI only. Okay? So, have you understood this managed floating? Have you understood this managed floating, or any doubt you have, please let me know. This is also known as DATI floating. This is also known as DATI floating. Okay? I hope you have understood this managed floating. Rijul has asked one question. So, what is mean by official transaction is not equal to 0? Anybody can answer it if someone has read NCERT. Anyone? Anyone can answer? Anyone can answer this official reserve transaction? No one. See, the point is, this is known as Darty floating. Why this is known as Darty floating? Because this interference of government or any authority in the market or in the exchange rate is not seen as a good feature or something is good by these developed countries, because these developed countries are fully market determined. So they do not like that if any country interferes or manipulate the exchange rate by interfering in the market. That's why this managed is termed as Darty floating, although it has some feature of this market determined, but still government interferes whatever there is a necessary. Okay. Excuse me. Coming to this doubt, official transaction is not equal to 0. That means RBI on behalf of the government interferes in the exchange rate market to maintain the exchange rate. Okay. That means if it would become equal to 0, that means it is you can say determined by the market forces, demand and supply. Since this has been interfered by the RBI, or it is not purely done by this market forces, that's why it is not equal to 0, which is this you can say this nomenclature or this terminology is used to determine this interference of the government or RBI in the exchange rate market. Okay. That's why for this managed floating, it is generally said this official transaction is not equal to 0. If it would be a market determined, then we can say it official transactions are equal to 0. Okay. Any other doubt, or we will move forward? Depreciation or devaluation we have already discussed. Please tell me, what are the merits of equal to 0? Means simply it is interfered by the market forces. Demand and supply are equal. At this point, this is what demand and supply are equal. By again change in the demand or the supply of dollar, again demand and supply of are equal. So that's why this official transactions are equal to 0. That means demand and supply is equal. But in case of fixed regime, this at this exchange rate E1, demand and supply are not equal. Here supply is greater than demand, here demand is greater than supply, and RBI is interfering in both the cases. That's why it is not equal to 0. Clear? Now coming to this merit and demerit of devaluation or depreciation. Please tell me what are the merits? हम एक करेंसी को डिवैल्यू क्यों करते हैं? Why depreciation or how depreciation is good for an economy? Anyone? Export. What happens to export? Export increases, or simply you can say exports become cheaper. The foreign nationals will demand more goods from your country. Clear? So when export increases, that leads to increase in the foreign exchange reserve, increase the production or manufacturing units. So this leads to economic growth. If you have seen or if you have read that export-led growth strategy, China is such example of export-led growth strategy. That means what? Your economy is more dependent on the export of goods. Okay? That means you are exporting more goods than you are importing. You are earning more of foreign exchange, which is good for your economy in terms of increase in production or manufacturing units. Right? To make any goods competitive, Rupok, this is the same thing, because exports are cheaper. This is the same thing to make goods competitive in the international market. Now, what is the demerits? Please tell me the demerits. Demerits of devaluation. The first one, inflation. Why inflation? Anyone can explain? We are discussing about demerits. Why inflation? Because at the time of devaluation and depreciation, it leads to increase in export, but import declines. क्योंकि import क्या होती है? महंगी होती है. You have to give, yes, imports are expensive. So those industries, they import raw materials, then they have to give a higher price. So when they will give a higher price, then it is reflected on the price of a product. That leads to inflation. Simply it reduces the purchasing power of individuals or citizens, or the purchasing capacity will decrease, or the value of the rupee will decrease. Any other demerits? Rapid devaluation may lead to capital flight, और जो इन्वेस्टमेंट आपकी कंट्री में थी पहले, दैट विल गो बैक टू सम अदर कंट्रीज. इट कैन ट्रिगर द कैपिटल फ्लाइट. अब ऐसे क्यों होता है? वाई रैपिड डिवैल्यूएशन में लीड टू कैपिटल फ्लाइट? वाई दिस हैपेंस? Why this happens? Because depreciation means rupee has become weaker, so it affects the sentiment of investors. That's why there is a possibility of capital flight. Okay, so these are some of the merit and demerits. Simply UPSC can put some point 1, 2, 3, 4, and they will ask which of the following are merits of devaluation or depreciation, or which of the following are demerits of devaluation or depreciation. This could be a question in your prelims. Now the next is revaluation. Just tell me the merit and demerit. What are the merits and what are the demerits? Revaluation. In case of revaluation, import will be cheaper. Import will be cheaper. Okay, and demerits, export becomes dearer, or export becomes expensive, or exports declines. Okay. Yes, that's true. Decrease in inflation and all. You can write some more points also. So just try to analyze both these concepts, depreciation and appreciation, and just try to find out some more merits and demerits. Okay. Now we are moving to a concept, current account deficit. Then what is this current account deficit? Current account deficit means simply what are the components under this current account? Yesterday we discussed that goods, services, okay, and some financial assets. So simply when I say that current account deficit, that means maybe deficit in terms of goods, maybe deficit in terms of services, maybe deficit in terms of this financial assets. Then what exactly the meaning of this deficit? Simply you are importing more than you export. You are importing more than you export. So when I say you are importing more goods than you export, you simply can say trade deficit. Trade deficit, or reverse will be the case, then trade surplus. Or if export of goods equals to import of goods, you can say trade balance or balance of trade, because trade deals with only goods. When I say services, that means invisibles. Yesterday I have already told you. So when import of services are greater than the export, then you can say deficit in invisibles. When this export equal to import, then you can simply say balance of invisibles. So invisibles deals with this services, trade deals with this goods. Clear? Now I introduced this term before you, current account deficit. So I already told you current account includes goods, services and financial assets. And when there is a deficit, that means you are importing more than you are exporting, or simply you can say this as well. I am denoting import as I or M, okay. These are the same thing. Import is greater than the export. Now, when this CAD or current account deficit is there, then the money which are coming to your country in terms of investment, okay, in terms of aid, in terms of grant, then you can finance this current account deficit from this capital account. I repeat, suppose in current account you have a deficit, that means you are importing more, you are paying more foreign currency than you are getting. So the difference of foreign currency that you are paying to other countries, from where you will get that currency or foreign currency, if there is an adequate inflow of capital account or inflow of foreign currency under capital account, then that foreign currency will help you to finance your deficit in the current account. But just imagine a situation when the capital account is also not that attractive, or the foreign currencies are not coming to your country adequately under this capital account, then this option is not there with you. Then what would be the alternative for you? Alternative is borrowing. So this is the first alternative. You will finance this extra payment of foreign currency from the capital account. That means the foreign currency that are coming to your country under this capital account through investments, grants, aids, etc. But if those investment, grant, aid are not capable to finance this deficit, then the alternative which is left with you, that is borrowing. You have to borrow money to repay or to finance those import bill. So when you start borrowing money from the market to finance your import bill, simply you can say current account is in crisis. What is the meaning of it? The meaning is you are simply borrowing for your consumption. The goods and services you are importing from other countries, for those goods and services you are borrowing from the market. Clear? So, that means current account is in crisis. So, this current account deficit, if financed through borrowing, which is known as crisis, this is known as your balance of payment crisis. This happened in 1991 in India. We started borrowing money. We ran out of our all foreign exchange reserves. We were dependent on the borrowing for this to finance this import bill. So, we went to IMF and World Bank for the assistance. This happened, this current account deficit, or when this current account deficit turns into crisis, then it leads to this balance of payment crisis. Another term which you might have heard, twin deficit. What is this twin deficit? Anybody can answer? What is this twin deficit? You might have heard it from newspaper or any article, editorials. What are those twin deficits? Twin deficits simply your current account deficit and fiscal deficit. Twin deficits simply current account deficit and fiscal deficit. Now, let's discuss current account deficit and its implications. Yes, twin deficit is fiscal deficit and current account deficit. Now, current account deficit, if continues in a country for a longer period of time, then what are the implications of it? Before this, I have already told you, till the time you are financing this current account deficit with this capital account, then there is not to worry, or there is not so much of concern about it. But the time when you start borrowing to finance this current account deficit, then there will be a problem. Okay? So, then it leads to this BOP crisis and all. Now, if a country suffers from this current account deficit for a longer period of time, then what would be the impact? So, can you please tell me what would be the impact for this current account deficit? Anyone? The first such is risk of depreciation. Depreciation of what? Depreciation of domestic currency. Depreciation of domestic currency. Then how? Suppose there is a current account deficit for a longer period of time, that means you are demanding more this foreign currency, demand for foreign currency is higher with respect to your what? Domestic currency. Okay? That's why there is further depreciation of domestic currency. There is further depreciation or weaker of the domestic currency. This is one such risk which is associated with current account deficit. Second, when I told you that CAD, when it is financed through borrowing, that means BOP is in crisis. What does it mean? When this crisis term is attached to something, then it hurts the sentiment of the investor. It hurts the sentiment of the investor. That means risk of capital flight. The risk of capital flight. Okay? So, there is a possibility the people will, or those investors will withdraw their investment capital from your country and they will move to some other countries from where they are expecting a more return. Okay? Risk of capital flight. Third, this is an indicator of uncompetitive. This is an indicator of uncompetitive economy. Uncompetitive economy. Because you are suffering or your country is suffering for a current account deficit for a longer period of time. Fourth, unsustainable. Unsustainable. What does it mean? It means you cannot sustain this current account deficit for a longer period of time. So, it will be termed as balance of payment crisis, and the rest is the story that we have already seen in our 1991 balance of payment crisis. Okay. Recently, I guess Sri Lanka is also suffering from the same kind of situation. So, if possible, please just refer to for your understanding purpose only, no need to go into that detail. Okay. Now, the next segment is, suppose a country suffers from this current account deficit for a longer period of time, but what are the options left with a country to minimize this current account deficit? I repeat, let's discuss what are the options left with a particular country to minimize the current account deficit. Can anybody answer? What are the options we have to minimize this current account deficit? Anyone? First, if we increase the export, then there is a possibility to increase the earning of foreign exchange. I repeat, if we increase the export, then there is a possibility to earn the foreign exchange. And how we can increase the export? Only through this devaluation. So, one option is devaluation of foreign devaluation of domestic currency. करंट अकाउंट डेफिसिट को मिनिमाइज करना है. if you adopt the path of borrowing, then we will become in that trap. That means your economy is not able to attract more of capital account. That's why you do not have enough foreign currency reserve to finance those import bill. So borrowing cannot be an option for you. Okay, so the first one is devaluation of domestic currency so that export can be increased. Through that you can earn some foreign currency. Second, what would be the second option a country have to minimize the current account deficit? Why this current account deficit is there? Because you are importing more. So let's minimize or reduce the import. Or simply you can say you can adopt policies like import substitution. You can adopt policies like this Atmanirbhar or self-reliance. जो आप import कर रहे हो from other countries, you will simply start producing in your country so that your dependency on other countries will come down, so that there will not be this increase in the current account deficit. You will produce more in your own country. Okay, import will come down, or you can adopt import substitution policy or this Atmanirbhar or self-reliance kind of policy. Okay, again, what would be your next step? Anyone? Contractionary monetary and fiscal policy. Contractionary monetary and fiscal policy, इसका मतलब क्या है? What is the meaning of it? Contractionary monetary fiscal policy means you are simply trying to reduce the consumption or aggregate demand in the economy. इसके वजह से क्या होगा? Import will come down. ठीक है, इसके वजह से import will come down. But there is some kind of problem with this contractionary monetary and fiscal policy. Can anybody explain this? What kind of problem will be there? What kind of problem with this contractionary monetary and fiscal policy? Yes, that's true, tight monetary policy, but इसके साथ एक problem attached है और associated है. What is that? It may lead to appreciation. It may lead to appreciation of foreign exchange. Appreciation of foreign exchange again worsening this current account. अब ये कैसे होता है? How this appreciation of foreign exchange? Yes, that's true. Public will not get money in their hand. That's true. So, demand for domestic currency will rise, okay, and higher rate of interest will lead to appreciation of foreign exchange, which is again reduce your export, again it will lead to current account deficit or worsening this current account deficit. Clear? That is what happens if you adopt this contractionary monetary policy. Then if you adopt this, then import will come down, but problem is with the appreciation of foreign exchange rate, export will come down, again you will fall in that trap of reducing or worsening of current account deficit. Clear? What are other methods to protect or to reduce this current account deficit? Protectionism. Simply use tariffs. Tariffs regarding what? Make the import costlier. Make the import costlier so that import will come down, so current account deficit can be minimized. Okay? So, these are some of the steps through which we can minimize the current account deficit. First one is devaluation, second is your reducing import, third contractionary monetary and fiscal policy, and then your protectionism. Okay. Now, we are moving to our next concept, dollarization. This is in news. In some economy, they are in bad shape. They lose their domestic, they lose the value of their domestic currency. So, they adopt a foreign currency as their domestic currency. So, that concept is known as dollarization, and it's frequently is in news because some economy suffers from this problem. That's why there is a possibility UPSC may ask you in the prelims. So, what exactly this concept is all about? Anyone can explain? Simply you can say that a country adopts a foreign currency as their domestic currency. For example, suppose India's domestic currency is INR, okay, but due to some problem with this INR, now India has decided to adopt dollar or any other foreign currency, let's say your euro or any other foreign currency as the substitute of INR or supplement the INR. I repeat, either you can fully substitute the foreign currency with your currency, or you can simply supplement, or along with the domestic currency you can adopt other foreign currency as your domestic currency. That is known as your dollarization. Simply you can say currency substitution. There are many countries they have adopted this method. I think Zimbabwe has also done it. Panama is a small country. that country has also done it. Okay. So, there are countries who have done this. So, the name is dollarization. That does not mean only dollar is adopted as the substitution of domestic currency. It means any other foreign currency can be adopted as the domestic currency along with the domestic currency or the complete substitution of the domestic currency. A point is why this foreign currency is adopted as the domestic currency, because you simply lose the trust on your domestic currency. What is that trust? Means simply your currency loses its value or domestic currency loses its value. If I read the newspaper that in Zimbabwe, it was in 3-4 years back, I mean more than that as well, in 2016 or 17, Zimbabwe was suffering from this, or Zimbabwe's domestic currency was suffering from this. So, the currency of Zimbabwe lost so much of value that the people were generally taking a full bag of cash to get a packet of bread. So, simply you can say the value of the domestic currency simply loses or just gone down, so that they adopt other foreign currency as their domestic currency. Okay. This is due to the problem or economic crisis, and this you can say the bad monetary policy measures. Okay. So, to give a stability to the domestic economy or to minimize this crisis like conditions, generally these countries go for this adoption of foreign currency as their domestic currency. Clear? Any other doubt till now? So, this is all about your dollarization, no need to go into any deep into it, simply just understand the concept, because this term is relevant for your prelims. Okay. If you have any doubt, please let me know. Any doubt? If you do not have any doubt, this is a new concept we are going to discuss, sterilization. This has already been asked once in UPSC. If you go to, I think, 15 years of this paper, you will find question on this. So, please tell me what is this concept all about? इसका क्या मतलब है? Sterilization. What is this concept all about? Anyone? Lucky, dollarization simply, I mean, it affects the money supply, but it depends on the economic situation of that domestic economy. Are you getting my point? How this dollar has been accepted by the individuals in that country, how frequently this dollar has been used by the people. So that depends, I mean, this money supply of the dollar depends on these economic or behavior of the consumers and individuals. Okay. When I was discussing this fixed exchange rate system, I have simply told you that if exchange rate is at E1, then E1 is the demand for dollar and E1B is the supply of dollar, and here supply is greater than the demand, and to maintain this exchange rate RBI will be asked to absorb this extra supply. This was we have already discussed, and again I have already told you that when RBI absorbs these quantity of extra supply of dollar, then RBI will inject or will exchange Indian rupee into the market. I repeat, when RBI absorbs or extracts those extra supply of dollar from the market, against that RBI will inject money or Indian rupee into the market. Now, from money and banking chapter, if you have remembered, money supply in the economy, with the increase in money supply, price level also increases. It's a simple relationship between money supply and price level, which is also known as inflation. Now, when RBI extracts this extra supply of dollar against Indian rupee, then when Indian rupee is injected into the economy, money supply also increases. That also creates this increase in price level or inflationary situation. Clear? Clear? Now, question is, why the supply of dollar increases in the economy? There is a possibility that investment is coming to your economy at large scale. Investment or capital inflow has been greater or has increased at a greater rate, that investment is coming to your economy, capital inflow is coming to your economy. But there is a possibility when RBI absorbs or extracts those extra supply of dollar from the market, there is a chance RBI will go for printing of money, printing of Indian rupee or printing of money to inject those extra money into the economy against those extra supply of dollar. What I told you in the first case, I have already told you, when RBI absorbs that extra dollar against Indian rupee, that means money supply in the economy increases, price level increases. Again, there is a possibility when RBI withdraws that extra supply of dollar against Indian rupee, but RBI does not have that much quantity of Indian rupee to supply it against those dollar. Why? Because in your economy, the capital inflow or the foreign currency that has come into your economy with a large in size. So to compare or to money or Indian rupee against those dollar is not available with RBI. Then RBI goes for this printing of Indian rupee. When RBI increased this money supply by injecting Indian rupee, by printing this Indian rupee, that again creates money supply and increase in price level. And again we have to assume increase in money supply does not lead to increase in production of goods and services equally or at equal pace with increase in money supply. Then only price level increases and inflationary situation arises in the economy. When inflationary situation arises, RBI is the authority to manage that inflationary situation. So whatever tools and techniques RBI uses to control the money supply in the economy, that is known as your sterilization. So RBI is controlling money supply which has come through this mechanism, or the money supply which has increased due to printing of money due to this mechanism only. So that is known as your sterilization. Clear? Any doubt on this? Any confusion? Please tell me. Any doubt? No problem, I will explain it again. I was saying, or simply coming to here only. In the fixed exchange rate regime, yes, it is Rijul, it's simply a tool to control money supply which increased, or the money supply increased due to what? This capital inflow. Or simply you can say due to this foreign currency inflow. Vachaspati, it's not about only printing the money. I was saying simply, okay, let me repeat the whole concept again so that you can understand. In fixed exchange rate system, I have already told you, जो extra AB, the supply of dollar है, that will be absorbed by RBI from the economy. अब जब उसको absorb किया जा रहा है, against that absorb of dollar or extra dollar, you need Indian rupee. RBI rupee supply to the market and absorbs dollar from the market. Dollar ले लेती है and rupee ये देती है. Now, sometimes जो existing Indian rupee होती है with the RBI, that is not sufficient to meet, to exchange against this extra supply of dollar. So next step is what? RBI will print money to exchange against these dollars. So जो money print किया जाता है, that means with the increase in money supply in the economy, that quantity of goods and services are not created. Simply money supply increased in the economy, that leads to increase in the price level or inflation. Or the method, then what should be the next step? Then RBI tries to control that money supply. When we were discussing the merit and demerits of fixed and flexible exchange rate, in case of fixed exchange rate, we discussed that RBI has to maintain a large reserve. In flexible exchange rate, we discussed that RBI can have an independent monetary policy. यहाँ पे RBI has to manage two things. One, this capital outflow and inflow to maintain a stable exchange rate. दूसरी, to maintain this price level or to stabilize this price level. ठीक है? So इसी को बोला जाता है, if it would be a market determined exchange rate, then RBI को कोई मतलब नहीं है कितना आ रहा है कितना जा रहा है. RBI will not do this work. RBI only will focus on this controlling inflation. Since it is managed or floating or the fixed exchange rate, then RBI has to manage this as well as RBI has to manage this inflation or price level. Clear? So this is known as your RBI is not independent to determining monetary policy under fixed exchange rate regime, but in market determined, RBI is independently determine the monetary policy. This is the difference. Now it is clear or still any doubt? Please let me know. अभी भी कोई doubt है तो then you can ask. See, why this term printing of new money is used? Because RBI already जो existing Indian rupee in the economy है, if that is injected into the system, then it's somehow manageable. But to meet this challenge, RBI क्या करती है? Will start printing new money to inject into the economy. Problem वहाँ से again start होती है. Suddenly there will be a rise in the price level. Clear? This is the case. Any doubt? क्या हो गया? सारे लोग चुप. No one is responding. ज़्यादा difficult लग रहा है क्या this concept? It is a simple one, don't worry. And simply UPSC will ask what is this concept all about? Simply maybe one-liner question or maximum in two-liner. Okay. Now the next concept is convertibility. Next concept is convertibility. What is convertibility? Again, this convertibility concept has already been asked, I think twice in the previous year papers. Last they had asked in 2015. Okay. So there is a possibility they can simply ask. Again, I am giving you another observation. This is my own observation. UPSC पहले क्या करती है? Just simply introduce a concept and simply ये पूछेगा कि ये है क्या? What is this? Then कुछ साल बाद उसको थोड़ा सा और डीप जाके 2-3 स्टेटमेंट में फिर पूछता है in the 2 or 3 liner statement. Okay. again फिर 3-4 साल बाद सेम कॉन्सेप्ट बट विथ अगेन सम न्यू डायमेंशंस. ठीक है. सो convertibility only they have asked the concept, but there is a possibility they can go into the deep. Okay. So what is this convertibility? Anybody? What is this concept all about? If you have solved previous year paper, you have idea, please tell me. What is convertibility? Simply you can say exchange of domestic currency into foreign currency at a market determined exchange rate. Convertibility is not about a fixed, it's not a fixed exchange rate regime. It is only a market determined or market determined exchange rate regime. That means flexible exchange rate, simply without any interference or without any restriction. If one currency is against the another, then that is known as your convertibility. In balance of payment, we have two accounts, I have already told you. Then one is your current account, another one is your capital account. This is capital and this is current. Clear? So if I say convertibility, then here current account convertibility. Again here also capital account convertibility. Clear? Capital account convertibility. So what is this current account convertibility? Anyone? What is this current account convertibility? Simply current account convertibility means current account deals with what? Goods and services. Simple. Convertibility means when you are or any trader, any merchants, any business persons, they are involved in this export and import. They can get their domestic currency exchanged with foreign currency without any restriction. Clear? Current account convertibility means when business persons, traders, merchants, they are involved in the goods and export and import of goods and services, if they are allowed to exchange it without any restriction, then that is your current account deficit. Coming to this part, capital account. What comes under this capital account? Simply your investment, this capital inflow, FDI, FPI, borrowings. If someone wants to invest in India and without any restriction, that person get the exchanged value of foreign currency and invested in India. That is known as your capital account convertibility. So this is the difference between the two, current account and capital account. Clear? In India, we have seen from 1991 onwards, we saw this phase LPG, and in this era we also introduced this convertibility. ठीक है? In 1992-93, we adopted a liberalized exchange rate system. We adopted liberalized exchange rate system. The term liberalized means you have to be liberal or you have to be withdraw of some kind of restriction on the exchange rate system. Since independence and before this 1992-93, we had this fixed exchange rate system. RBI was the authority which was determining, maintaining the exchange rate. But from 92-93, we adopted this liberalized exchange rate system. Why? We took loan from World Bank and IMF under this LPG reform. So there was a condition under this LPG reform to implement such policies. So we adopted liberalized exchange rate system from 92-93. Under this system, 60% of foreign exchange earning, 60% of foreign exchange earning through market determined, and 40% through fixed, or RBI was doing this. अब ये कैसे होता है, बहुत डिटेल जाने की जरूरत नहीं है, स्टिल आई एम गिविंग यू दैट क्लू. They fixed these goods will have market determined, and these are the list of those goods where the RBI will determine the exchange rate. So 60% was market determined, 40% through RBI. Now, it was introduced in 1992 in the budget only, 92-93 budget, by the then Finance Minister Manmohan Singh. Okay? Now, in the March 1993, again in the budget, just you can say just after 1 year only, we finally moved towards this flexible exchange rate system. We moved finally this flexible exchange rate system, and these two exchange rate system was merged. These two were merged, and finally in the 1994 we started this market determined. Market determined, and all these concepts I have discussed with you, that is related to current account. हम यहाँ पे कैपिटल अकाउंट की बात ही नहीं कर रहे हैं, हम लोग यहाँ पे बस करंट अकाउंट की बात कर रहे हैं. फर्स्ट, in the year 92-93 we adopted liberalized exchange rate, and some commodity 60% was the market determined, 40% was the RBI determined, and in 1993 we merged these two, and finally in 1994 we adopted this market determined, that means current account convertibility. ठीक है, अभी there is no such restriction in the current account to exchange domestic currency with the foreign currency. Now in the current account, the exchange rate of rupee is market determined, that is demand for and supply of. Clear? इसमें कुछ डाउट है आप लोगों को? In this any doubt you have, please let me know. So in the present system, in the present era, India has fuller current account convertibility. India has fuller current account convertibility. What happens in the capital account we will discuss tomorrow. Tomorrow we will end this chapter and we will start a new chapter. Okay? Tomorrow we will discuss about capital account convertibility. So this is all about your current account convertibility. Simply you can exchange one currency into another without any restriction, and India has this current account convertibility now. We are adopting it. So if you are a trader, if you are involved in export and import of goods and services, there is no such restriction imposed to get the currency exchanged in terms of a foreign currency. अभी तक कोई डाउट है, कुछ कंफ्यूजन है, प्लीज टेल मी. Topic for tomorrow. Okay, tomorrow we'll end this chapter, this external sector. If possible, we'll start planning. Okay, planning will start. We'll try to wind up planning tomorrow only, because it's a, I mean, it's not, I mean, you can expect 1 or 2 questions. It's not a long topic. We'll wind up this planning tomorrow only. We'll try to do that. Jyoti has asked, what is currency pegging? Anyone can answer that? See, if you might have seen these 2 terms like flexible and pegged. Flexible means simply the market determined, and pegged means the fixed one. So pegged currency means simply you can say the currency which is determined through the government, or government fixes the exchange rate. Okay. Okay, so yes, this is a question we discussed today. So please tell me, consider the following actions which the government can take. 1, devaluing the domestic currency, a reduction in the export subsidy, adopting suitable policies which attract greater FDI and more funds from FIIs. Which of the above action or actions can help in reducing the current account deficit? आंसर क्या होना चाहिए? Anyone? Devaluing the domestic currency, that means we need to increase our export. Devaluing currency means need to increase our export, जिसके वजह से we will earn more of foreign exchange, and so that we can finance that import bill. Reduction in the export subsidy. What is this export subsidy? Suppose a person A is exporting, let's say, a product at ₹100, and the government will ask that person, you export this at ₹90, the 10 rupees will be provided by the government. Okay, so that means it will, the export subsidy, that means it will encourage the export. But when reduction in the export subsidy, that means it will discourage export. That means it will reduce export. When export will be reduced, then it will bring down your earning of foreign exchange through which you can finance the import bill. So, this cannot be a answer, this cannot be an answer for this. So, reduction in export subsidy is the wrong statement. Okay. Adopting suitable policies which attract greater FDI and more funds from FII. See, this FDI and FII a part of capital account, but when I was discussing this current account deficit, I have already told you, till the time you are financing this current account deficit through this capital account, then it's fine. If you are not able to finance this through capital account, then you have to adopt the method of borrowing. वहां पे फिर दिक्कत आना चालू होता है. You have to adopt the method of borrowing. So, although this is a part of capital account, but still you can reduce your current account deficit through this method. So, 3 statement is correct. So, 1 and 3 is the right answer. Okay. Yes. Consider the following statements. The effect of the devaluation of a currency is that it necessarily 1, 2, 3. First, improves the competitiveness of the domestic exports in the foreign market, increase the foreign value of the domestic currency, improves the trade balance. What would be the answer? Please tell me the answer. A 1 only, B 1 and 2, C 3 only, and D 2 and 3 only. Rijul is answering A. Okay. Devaluation means simply you can say your currency has become weaker. Devaluation means simply you can say currency has become weaker. That means second statement is wrong. But please tell me why we will consider this improve the trade balance as the wrong statement as per your answer given by you A. Can you please explain the third statement why we will consider improves the trade balance as the wrong statement? Anyone? But I'm just trying to why not 3? Okay, there is no such option 1 and 3. So, everyone is agree with Rijul that it must be 1 and 3 since option is not there. So, that's why we have marked A. Everyone is agree with Rijul. Chayan is saying B. No. Only answer is only A. But my question is why we are considering this improves the trade balance is the wrong statement. But Rijul is saying no. This third statement is also correct. But since the option is not there, that's why we are considering A only. Is it true or is it fine with everyone, or any other separate or any other answer we can expect from others? See, improves the trade balance. What is the meaning of that? Meaning is you are exporting more than the import. You are exporting more than the import. This is your improves the trade balance. But just try to understand this. Suppose we did the devaluation, or government did the devaluation, but although export increased, export increased in comparison to the previous export, but export may not greater than the import. You do not know about the import prevailing in your economy. You do not have any idea what exactly the situation of import at this point of time. Export increased, no doubt, but trade balance means export will greater than the import. Here import is less than the export or equal to import, or what you never know. Sorry, balance here means equal. Sorry. Trade balance means simply export equal to import. But due to this devaluation, export is increasing, but you never know what is the rate of import. Clear? So you cannot say due to this devaluation it will improve the trade balance. Okay? That's why you can simply say you can say it may improve the trade balance or may not. Clear? Since you do not have any idea what exactly the import of current scenario, that's why we can simply skip this statement, or we can assume it may improve or may not. So the perfect or the right or the most appropriate answer is A1 only. I hope it's clear. Yes. Anyone can answer it. If another global financial crisis happens in the near future, which of the following actions, policies are the most likely to give some immunity to India? Okay, let's drop this, because tomorrow we'll discuss this, maintaining the full capital account convertibility, what is all about. So if possible, tomorrow we'll discuss this question, that would be the more appropriate. Okay? Yes, simply solve it. Convertibility of rupees implies what should be the answer? Allowing the value of rupee to be fixed by the market forces. No restriction. No restriction. Okay? Okay? Yes, C is the answer. C is the right answer. It's not B, it's C only. Freely permitting the conversion of rupee to other currencies and vice versa. It's not about the fixed, it's the conversion of rupee. So this is the difference between the two. It's not fixed, it's the conversion. Okay. So that's it from my side. If you have any query, any doubt, please let me know. And we'll meet tomorrow. We'll continue this chapter. We'll end this and we'll start a new one tomorrow. Okay. So thank you very much. We'll meet tomorrow and have a nice day.